You're scrolling through investment forums at midnight. Everyone's talking about their returns: 12% in real estate, 15% in corporate bonds, 20% in some new crypto thing. And you're thinking, maybe you're missing out. Maybe it's time to get aggressive with your money. Here's what nobody's telling you about those numbers. The people bragging the loudest are usually the ones about to lose everything. Because right now, in early 2026, Europe is sitting on a pile of investment landmines that look like opportunities. Shiny, tempting, profitable on paper, catastrophic in reality. And the worst part? The most dangerous investments aren't the obvious scams. They're the ones that sound safe. The ones your neighbor is doing. The ones your bank is selling you with a smile. I'm Leo. I spent 9 years analyzing European markets after moving here from the States, and I've watched people make the same expensive mistakes over and over. If you want to protect your money in 2026 and actually understand what's happening in European markets right now, hit that subscribe button. Because what I'm about to show you could save you from losing years of savings in investments that everyone thinks are safe. Here's the thing about dangerous investments: they don't announce themselves. Nobody walks into their bank and asks for the financial suicide package. These traps are sold as smart moves, conservative plays. Can't miss opportunities. And right now, Europe has more of them than any time since the 2008 crisis. I'm going to walk you through the 10 most dangerous places European investors are putting their money in 2026. Not theoretical dangers, real traps that are already closing on millions of people. And then I'll show you what to do instead. Because the irony is brutal. The safe path is boring, simple, and sitting right in front of everyone. But it doesn't promise 20% returns, so people ignore it while chasing grenades disguised as gold bars. Let's start with the biggest trap of all. The one that's going to hurt the most people because it feels so safe. Over-leveraged European real estate. You know the play. Property prices always go up. Buy an apartment, rent it out, build equity, retire rich. Except that's the logic from 2005. And we all know how that story ended. Here's where we are in 2026. European property prices relative to income are at all-time highs. Not just high, all-time highs. In Germany, the average home costs more than 10 times the median annual income. In France, it's worse. Interest rates that spent a decade between 1 and 1.5% are now sitting at 4 to 5%. And here's the nightmare scenario playing out right now. Millions of European homeowners took out 90 to 95% loan-to-value mortgages when rates were rock bottom. Those mortgages are hitting their refinancing dates, and suddenly, that affordable monthly payment just doubled or tripled. According to the European Central Bank's Financial Stability Report from 2025, we're looking at a refinancing cliff that's going to hit hard through 2026 and 2027. But wait, it gets worse. Property values are already declining in key markets. Germany saw a negative 1.6% decline in 2024. That might not sound like much, but when you're leveraged at 95%, a 10% price correction means you're underwater. Negative equity. You owe more than the property is worth. Now add Italy's 140% debt to GDP ratio, creating sovereign risk that affects property markets. Add the fact that price to rent ratios are above 25 years in major cities. That means if you bought an investment property at current prices, it would take 25 years of rental income just to break even, ignoring all costs. So you're buying a 5% yield with a 4.5% mortgage rate. Your margin for error? 0.5%. One vacancy. One major repair. One interest rate bump. And you're bleeding money every month. The people telling you real estate is safe right now are either selling real estate or haven't done the math. This isn't 2010 anymore. The easy money era is over. And the investors who treated property like a guaranteed ATM are about to learn an expensive lesson about leverage, timing, and what happens when markets correct. Now, you might be thinking real estate sounds too risky, so maybe bonds are the safer play. Corporate bonds, steady income, professional management. That's the pitch anyway. Let me show you why high-yield corporate bonds might be even more dangerous than over-leveraged real estate. Credit spreads at the start of 2026 are historically tight. That's finance speak for the difference between safe government bonds and risky corporate bonds is tiny, which means you're not getting paid enough for the risk you're taking. Corporate debt service ratios are stable for now, but rising. And here's the time bomb. A massive wave of corporate debt issued during the COVID era at near zero rates is maturing in 2026 and 2027. Companies that borrowed at 1% are going to refinance at 5%. Some of them won't survive that math. The Bank for International Settlements credit market data shows corporate leverage at levels that historically precede defaults. Investment-grade bonds, the supposedly safe ones, offer almost no cushion. High-yield bonds, the ones paying 8 to 12% that look so attractive, are called junk bonds for a reason. They're the first to collapse in a recession. One economic hiccup and those steady payments turn into defaults. Now layer in sovereign risk. France at 117% debt to GDP. Italy at 140%. When governments are this leveraged, it creates systemic risks that ripple through corporate bond markets. A sovereign crisis affects banks. Banks affect corporate lending affects defaults. It's all connected. And right now, the connections are tight and fragile. What I'm about to show you next is the thing that took me years to figure out. Because it looks smart on the surface. It sounds sophisticated. And it's burning people's money faster than almost anything else. Concentrated sector bets. Thematic investing. European investors are piling into AI pure plays, clean energy funds, single country ETFs, and they're calling it strategic. The European Securities and Markets Authority has been warning about this for 2 years. Here's what most people don't understand about concentration risk. According to research from Morningstar, the top 0.3% of US companies drove 50% of all wealth creation since 1926. Read that again. 0.3% created half the gains, which means 99.7% either matched the index or underperformed it. When you make concentrated bets, you're gambling that you can pick the 0.3% winners. Spoiler alert, you can't. Nobody can. Not consistently. Not over time. Thematic ETFs marketing themselves as the future of investing charge 0.65 to 0.85% in fees, and almost all of them underperform broad market indices. Remember clean energy funds in 2021? Everyone knew green energy was the future. Can't miss, right? Those funds are down 30 to 50% from their peaks despite the green transition narrative being stronger than ever. Why? Because narrative doesn't equal returns, hype doesn't equal profit, and concentration doesn't equal smart. Single country European ETFs are another trap. You're taking on idiosyncratic risk, political risk, regulatory risk, all for what? The chance to beat a diversified index by maybe 1 or 2% if everything goes perfectly? And when it doesn't, you lose 20 to 30% while diversified investors lose 10. That's not strategic, that's gambling with extra steps. Now we get to the part that actually matters. Everything before this was just context, because what I'm about to reveal is the investment category that's going to separate people who preserve wealth from people who watch it evaporate. And it's the most hyped, most misunderstood, most dangerous trap for retail investors in 2026. Cryptocurrency speculation. Notice I didn't say cryptocurrency investing, I said speculation. Because that's what 98% of retail crypto activity is. Here's the brutal truth that crypto evangelists won't tell you. The median retail crypto participant loses 90% or more over 3 to 5 year periods. Not the mean. The median. Half of all retail crypto investors lose at least 90%. The 2021 to 2022 crypto crash wiped out over $2 trillion. Exchanges collapsed. Tokens went to zero. And now, in 2026, a new wave of retail investors is lining up to repeat the exact same pattern. Yes, blockchain has utility. Yes, some institutional players are involved. But retail crypto investing typically means buying digital tokens based on Reddit posts and YouTube videos, holding them on exchanges you don't control, and hoping someone else will pay more later. That's not investing. That's the greater fool theory with fancy technology. The implementation of DAC 8 in Europe brings regulatory scrutiny and reporting requirements that most crypto investors aren't prepared for. Exchange risk remains massive. We saw multiple exchange failures between 2022 and 2024. Your crypto isn't yours if it's on an exchange. And if the exchange collapses, you're an unsecured creditor fighting for scraps. Plus, correlation with traditional risk assets means crypto offers no diversification benefit. When stocks crash, crypto crashes harder. When markets rally, crypto is volatile and unpredictable. You're taking on massive additional risk for returns that mostly accrue to the people who got in early, and the exchange is taking fees on every transaction. Here's where it gets interesting. Because the next trap is one that European regulators actually tried to protect people from, but the industry found ways around it. Peer-to-peer lending platforms. The pitch sounds great. Cut out the banks, lend directly to borrowers, earn 8 to 12% returns, be the bank, except you're not the bank. Banks have capital requirements, stress tests, deposit insurance, regulatory oversight. You have a website interface and hope. The European P2P industry has matured since the Wild West days, sure, but matured doesn't mean safe. Default risks are massive and rising. Platforms don't have deposit insurance, which means total loss is possible and has happened. Illiquidity traps during market stress mean you can't sell your loan positions at any price. You're locked in watching your investment deteriorate. Multiple platforms have failed historically, leaving investors stranded with worthless claims. And here's the kicker. The returns often don't compensate for the risk relative to simpler alternatives. You're earning 10% on P2P loans while taking on default risk, platform risk, and liquidity risk. Meanwhile, a diversified bond ETF gives you 5 to 6% with full liquidity, no platform risk, and actual regulatory protection. You're getting paid 4% extra to take on 10 times the risk. That's not a good trade, that's a trap dressed up as innovation. Okay, quick check-in. Still with me? Good, because what comes next is the part most people never hear about. The investments that sound so safe, so protected, so sophisticated that people hand over their money without asking basic questions. Complex structured products. Your private banker smiles and shows you a beautiful presentation. Capital protected product. You can't lose your principal. Plus, you get 70% of the upside if markets go up. Sounds perfect, right? Here's what they're not telling you. Capital protection only applies at maturity. Could be 5 years, could be 10. During that time, mark-to-market losses can be significant. If you need your money back early, you're selling at whatever price the bank offers, which is always lower than you expect. The fees are hidden but brutal. 1.5 to 2.5% annually, baked into the product structure. You don't see them on a statement, but they're there, eating your returns year after year. The upside participation is capped severely. That 70% participation is usually capped at a total return. So if markets go up 50%, you get capped at maybe 20%. The bank keeps the rest. And all of this is wrapped in Eurozone bank solvency risk. Given the high sovereign debt levels across Europe, bank stability isn't guaranteed. Your capital protected product is only as safe as the bank issuing it. According to research from Morningstar Investment Risk Analysis, the typical structured product costs investors 2% annually in fees and lost opportunity cost compared to simple index investing. You're paying someone to cap your upside, lock up your money, and expose you to bank risk. That's not sophisticated. That's expensive and restrictive. Let's talk about frontier and emerging market bonds. The diversification play. The high-yield international opportunity. Except this is where European retirees are getting demolished right now. Emerging market equity offers legitimate diversification benefits. Emerging market sovereign bonds? That's a different animal entirely. You're taking on currency risk, inflation risk, and default risk. Those risks aren't theoretical. Sri Lanka defaulted. Zambia defaulted. These are real events that wiped out bondholders. Chinese property bonds are a particular danger zone in 2026 given the ongoing real estate crisis there. Developers defaulting left and right. Bondholders recovering cents on the euro if anything. And European investors bought these bonds chasing yield without understanding the risk. Here's the thing about sovereign defaults. When a country can't pay, you don't have recourse. You can't repossess anything. You can't sue effectively. You're in line behind the International Monetary Fund and other preferred creditors. Your bonds get restructured at a massive loss or turn into worthless paper. The extra 3 to 5% yield you earned for a few years doesn't come close to compensating for a 70% haircut when the default hits. This is retiree money getting vaporized because someone chased an extra few percentage points of yield without understanding what they were actually risking. Now let me tie all of this together, because when you see how these pieces connect, everything changes. There's a category of investment products that's designed for day traders but marketed to everyone, and people are buying them thinking they're sophisticated tools when they're actually financial self-destruct mechanisms, leveraged and inverse ETFs. These products use derivatives to deliver 2 times or 3 times the daily return of an index, or -1 times the return. They're designed for traders who hold positions for hours or maybe a single day. They are explicitly not designed for buy and hold investors. But guess what European retail investors are doing? Buying and holding them. Here's why that's disastrous. Daily rebalancing causes decay. Even if your directional bet is correct over time, the math of daily compounding works against you. Hold a 3 times leveraged ETF for a month, and you'll likely lose money even if the underlying index went up. The structure guarantees it. European investors who don't understand these instruments are using them as long-term holdings and watching their money evaporate. The product is doing exactly what it's designed to do. The investor is using it wrong, but the result is the same. Loss. Then we have IPOs and pre-IPO investments. The allure of getting in early. The dream of buying the next big thing before everyone else. Here's the reality according to long-term market data. The average IPO underperforms the market in the years following its listing. Companies go public at market peaks when valuations are highest. Insiders and early investors are cashing out at your expense. You're not getting a deal. You're providing the exit liquidity. Pre-IPO opportunities marketed to retail investors are even worse. Massive markups. Extreme illiquidity. Many are outright scams. The post-SPAC crash in 2022 showed exactly how this plays out. Retail investors bought the hype. Insiders sold at the peak. The SPACs collapsed. Retail lost 70 to 90%. The pattern repeats because the fundamental dynamic never changes. When someone's trying to sell you an early investment opportunity, ask yourself why they need your money. If it's such a great deal, why aren't insiders keeping it for themselves? Almost there. But before I wrap up, I need to show you how all of this works together. Because there's one more category that ties directly into everything we've talked about. Tax optimization schemes. Luxembourg structures. Cyprus holding companies. Complex trust arrangements. The pitch is always the same. Massive tax savings. Completely legal. Smart money does this. Here's what actually happens. These schemes cost more in fees than they save in taxes. Lawyers, accountants, setup costs, annual maintenance, it adds up fast. They create reporting nightmares under DAC 8 and BEPS regulations. One mistake, and you're facing penalties that dwarf any tax you saved. And many of them are deemed abusive by tax authorities after the fact, which means you pay back taxes, plus interest, plus penalties. The Pillar 2 global minimum tax at 15%, implemented January 2026, closed many of the loopholes these schemes relied on. So people paid thousands in setup fees for structures that became worthless overnight. Unless you have millions in assets and sophisticated tax counsel, these schemes are almost always a net loss. The promised savings rarely materialize, the complexity creates risk, and the legal exposure is massive. You're better off paying your taxes and investing in boring index funds. At least then your money is working for you instead of funding lawyers and accountants. So how do you identify danger before it's too late? Here's the checklist. Promises of high returns with low risk. Impossible. Risk and return are correlated. Always. If someone promises you 15% returns with no risk, they're lying or they don't understand what they're selling. Complexity requiring trust in a promoter. If the investment requires detailed explanation of a complex mechanism and you have to trust someone else to manage it, that's a red flag. Simple investments are transparent. Complex ones hide risk. Illiquidity preventing exit. If you can't sell your position easily at a fair price, you don't really own an investment, you own a trap. Leverage amplifying risks. Borrowed money magnifies gains but also magnifies losses. And in markets like 2026, leverage is a wealth destruction mechanism. Lack of regulatory oversight. If your investment isn't regulated, you have no protection when things go wrong. And things always eventually go wrong. Conflicts of interest where promoters earn fees regardless of outcome. If someone makes money whether you win or lose, their incentives aren't aligned with yours. They want you in the product. They don't care if you profit. Here's the safe alternative that nobody wants to hear because it's too boring. VWCE or IWWDA. Vanguard or iShares, broad market index ETFs. They've returned 8 to 12% annually over long periods. Full liquidity. You can sell any trading day at fair market price. No counterparty risk. You own actual shares in actual companies. Minimal fees, 0.20 to 0.22%. Compare that to the 2% hidden in structured products. Complete transparency. You know exactly what you own at all times. Yes, the returns are lower than what the dangerous investments promise, but these returns are real, delivered, actual. The dangerous investments promise 20% and deliver -50. The boring index fund promises 8 and delivers 8. Over 20 years, that difference is the difference between financial security and starting over at 65. Let me bring this full circle. Remember that midnight scrolling, everyone bragging about their returns? Here's what happened to those people. The guy boasting about 12% in real estate is now underwater on his investment property, bleeding cash every month because he can't rent it for enough to cover his new mortgage payment. The woman who got 15% in corporate bonds, 3 of her holdings defaulted in the 2026 recession. She's down 40%. The crypto bro who made 20% last year, he held through the correction and gave it all back plus his original investment, down 75% and still believing it'll come back. They're not posting about that. The forums are quiet now, the bragging stopped. But the losses are real. Your future self, 10 years from now, is depending on the decisions you make today. The boring decision to buy VWCE and hold it. To ignore the hype. To avoid the traps. That decision might feel unsexy right now. It might feel like you're missing out while everyone else is getting rich. But everyone else isn't getting rich. They're taking enormous risks they don't understand, chasing returns that don't exist, and learning expensive lessons about leverage, complexity, and the difference between narrative and reality. You have a choice. You can chase the shiny objects and join them, or you can take the boring path that actually works. What topic should I break down next? European tax strategies that actually work. How to build a portfolio for 2026? The real cost of lifestyle inflation? Drop your idea in the comments. Your future millionaire self is counting on you to make the smart choice, not the exciting one, the smart one. And in 2026, in Europe, with markets sitting where they are, the smart choice is simple. Avoid the 10 traps I just showed you. Buy the boring index fund. And let compound interest do what it's done for a century. That's not exciting. But it works. And working beats exciting every single time.